Hello everyone, welcome back to our weekly webinar series. My name is Faiza Hashmi. I'm the tax director here at Quest Cooper. Today I've been joined by my colleague Mahar Afzal, and together we will be taking you through today's webinar. So since the last couple of weeks, we have been discussing the tax group guide. The FTA has introduced the guide for the tax group in January. And since the last 3 weeks, we have been discussing this guide. It's a very detailed guide, and we have been taking different portion and section of this guide and discussing in our previous lectures. So if you have missed any of our lectures on the tax group guide or on any of the other topics, they are available on our YouTube channel, and you can always see them there. And if you have any questions, feel free to email us at info@presscooper.com and we will be happy to reply to you. So today, let me recap some of the things that we discussed in the previous lectures, and then Mahar will take you through the topic of the today. So first, we had discussed in our previous lectures that what is a tax group. So when two or more taxable persons, they are meeting the condition under Article 40 of the Corporate Tax Law, they can be treated as a single taxable person, and a tax group can be formed from them. So what are these conditions? So the conditions that Article 40 talks about that they should be met, they are that the parent and the subsidiary should be resident juridical person. When we say resident juridical person, we mean by resident person that they should be resident of UAE. So both the companies need to be resident of UAE. For that, we mean they either need to be incorporated in the UAE or they need to be, if they're incorporated outside of the UAE, they might be managed and controlled from the UAE or under a double tax treaty, if that exists between two countries where the companies are incorporated, then they need to be resident under the rules of that double tax treaty in UAE. So then they will be called resident in UAE. And they need to be juridical persons, which mean that they need to have a legal entity separate from their owner, which means that natural persons or unincorporated partnerships, civil companies, they cannot be part of the tax group. They need to be legal entities like LLC companies, private companies, public joint stock companies. Then only they will be able to form or be part of a tax group. Then there are the condition where the parent company needs to have at least 95% ownership in the share capital. By this, we mean the legal ownership of the share capital in a company, needs to have 95% ownership of the voting rights in the company, needs to have 95% share in the distributable and non-distributable profit of the company. The parent needs to have 95% entitlement in the net assets of the company at the time of liquidation or winding up. Then we had discussed that a tax member of a group cannot be a qualifying free zone person. So if they are meeting the status of a qualifying free zone person, they cannot be part of this tax group. If they want to opt out of that or they are just free zone companies, they can still be part of the tax group. They should not be exempt person under the law. If they have claimed any exemption or have been given any exemption, they cannot be part of a tax group. Then all these companies, the parent and the subsidiaries, they need to have the same tax period and they need to be following the same accounting standards. So we had also discussed that the important thing is that all these conditions need to be met and they need to be continuously met during the whole tax year. So then only this tax group can be formed. So when these conditions are met, the parent company can form a tax group with the subsidiaries which are meeting this condition. Now, we had also discussed that for the share capital ownership condition or the voting right condition, the profit and the net asset condition, we are talking about the parent can either have direct ownership or it can have indirect ownership. So the important point we discussed here was that indirect ownership needs to be through a subsidiary, which means that the indirect ownership which the parent is looking at, the company through which the indirect ownership is being held, needs to be at least 95% owned by the parent. Only then it will be counted as a intermediate subsidiary, and then only through that can an indirect ownership be calculated. So we had looked at two examples, where in example one, this condition was not being met, where company A is holding only 80% of company C. So even though there is an effective, ownership, shareholding more than 95, but since it is not through a subsidiary, it cannot be counted. But in example two, because company C is a subsidiary of company A, so it is meeting the condition and indirect ownership can be condition can be met. Then we had looked at that in a tax group, there can be any number of members, but one member of a tax group can only be a member of that tax group and cannot be member of more than one tax group. So we had seen this example where Company A and Company C were not meeting the condition to be part of the same tax group, but Company B was meeting the condition to be part of the tax group for both, with both Company A and with Company C. So now here Company B has a choice that it can either form a tax group with Company A or either form a tax group with Company C. It cannot be part of both the tax group, because we want to reiterate that this tax group is a single person, treated as a single person, so they cannot be part of more than one tax group. We had also discussed that once the parent company and this tax group is formed, then the parent company takes some responsibility like a representative member, and it needs to fulfill these responsibilities like apply for any new subsidies to form part of the tax group, prepare the consolidated financial statement. It needs to file the tax return on behalf of the members, needs to settle the corporate tax payable, apply for any tax refund, manage the registration, deregistration for the group, maintain any supporting documents, or apply to FTA for any clarification. So anything will be done through the parent. So then we had also discussed the life cycle of the group, that what can happen. So for example, to apply for a tax group or to apply for a new subsidy to be included in a tax group, or for an application for deregistration, the parent company will need to make this application. Then if a group member is failing to meet any conditions, one of the conditions that we just discussed, if any of those are not being met by any of the subsidies, they need to leave the tax group within 20 days of that condition not being met. Then if a parent company is leaving, so the tax group doesn't need to be deregistered if our new parent company is replacing it, if it is meeting all the conditions of the existing parent company, or it is a legal successor of that parent company. So then, the tax group can continue to exist. Then if any group member leaves the tax group, so the whole group does not cease to exist until all the members basically are ceasing to exist or do business. So we will look at it from a tax group level. So if only one entity is, let's say, cease to exist or cease to do business, then they can be, leave the tax group. If there are only two members in a tax group, then yes, you will need to deregister. So now when the corporate tax group is now established, it is considered as a single taxable person, like we discussed before. We said the parent company is responsible for now, certain responsibilities. One of them was combining the financial accounts. So now once the members have their own individual accounts, the parent will be responsible to combine them and consolidate those accounts. So they should be following the same accounting standard, which is also one of the conditions. Single tax return is going to be filed now for the whole group, since it is treated as one single entity for FTA. And if parent company fails to settle this liability to the FTA, all the members are jointly liable for this. This liability can be restricted between some members, but that needs to be approved by the FTA. So now let's discuss elimination of intergroup transactions. So we had also in the last webinar discussed that when the parent is consolidating the financial result of these group entities, the intergroup transaction need to be eliminated here. Now, when we talk about intergroup transactions, we talk about transactions between the parent company and the subsidiaries, and also transactions between the subsidiaries. So, for example, if A is a parent company and B, C, and D are subsidiaries in the same tax group, so any transaction which the parent is doing with, let's say, A is doing with B, or B is doing with C, or C is doing with D, that will be eliminated when we are doing this consolidation. So let's take an example. If company B sells an asset to company D, so this transaction will be disregarded for the tax consolidation. The important thing here is to note that this transaction has to take place during the tax year where all these parties, A, B, C, D, were part of the tax. So for instance, let's say company A paid 100,000 of interest to company B in a tax period, and company A and B form a tax group effective from the beginning of the same tax period. So then this interest which is paid in the tax period in which the tax group is formed will be eliminated, since it is from the same tax year when the tax group has already been formed. So this requirement to eliminate the intergroup transaction within the tax group will also apply to valuation adjustments, to provisions, any changes in the accounting value of assets and liabilities that arise as a result of gain and loss from any transaction within the tax group. It will apply to income and expenditure both. So let's take an example. One member of a tax group, company A, is providing a service to another group of the tax group, company B. This will result in an expense for one company. It will also result in an income for another company. So when the consolidation is happening, this transaction will be eliminated and will not be taken in the tax group. So now the important point here is also that it needs to be done when both are the members of the tax group in the same year. So why I keep emphasizing that both the parties need to be members in the same tax year is because there is one exception to this elimination, and that is the case where if the members, basically if there is any intergroup transaction, where a member has recognized a deductible loss in a tax period before joining the tax group, if they have recognized the deductible loss, then this will not be eliminated. See, because it was not done during the same tax year where both the companies between whom these transactions have happened were part of the tax group. So this transaction will not be eliminated, and the income will be included in the taxable income of the group up to the amount that was previously deducted by the company before joining the tax group. So let's take an example. One member of the tax group has recognized a deductible loss by impairing a loan receivable due from another member of the tax group prior to joining or formation of the tax group. So in this case, the relevant transaction will not be eliminated. Any income in relation to this transaction, for example, reversal of impairment, it will be included in the taxable income up to the same amount as was previously deducted. After the reversal of the impairment has been taken into account, then only this exception will no longer apply and the loan will be eliminated for the intergroup transaction. So this is one exception to elimination of the intergroup transaction. Then we had also discussed the limitation of the tax loss carry forward. So we had discussed that if there's already a tax group and a subsidiary is joining the tax group and that subsidiary already is in losses, it already has carry forward losses, let's say. So those carry forward losses that it is bringing inside the tax group, they will be termed as pre-grouping tax losses. And these tax losses will remain the tax losses of the subsidiary. They can be part of the group, but they will be only offset against the income of that subsidiary and not with the income of the rest of the group, because were the losses of the subsidiary before they became part of the group. And the 75% tax loss relief limit will also apply to the taxable income of the tax group as a whole. So that's another condition as well. So if there is any losses which the subsidiary has brought into the tax loss from and for existing tax losses, they will be called pre-grouping tax losses, and they will only be offset against the income of that subsidiary. In the same manner, if that subsidiary leaves the tax group and there's any remaining tax losses which it had brought into the group and that has not been utilized, so that they can leave with that tax losses. But the same will apply for a group. For example, there is already an existing tax group, it already has tax losses, and now a new subsidiary is joining in. So those existing tax losses, they cannot be set off against the income of the new subsidiary, only against the income of the other members who are already existing in the tax group. And if a subsidiary is leaving the tax group, it can take away any pre-grouping losses, but any losses which were incurred while it was part of the tax group, that remains with the group, basically. And this 75% limit, again, like I said, on the carry forward losses, it will be looked at from a tax group level. So I think now I'll hand it over to Mahar, who will now be taking you through the topic of the today. Yeah, just a minute, I'll hand it over. Yes, Mahar, you can take it from here.
Hello, everyone. Thank you very much for joining us once again, and thank you, Faiza, for detailed explanation on the tax group. We are still discussing tax group and taxable income of the tax group. In our previous webinar, we have discussed how to calculate the taxable income of the tax group. We discussed that the parent company will be liable to consolidate the financial results of the individual entities. All intra-group transaction will be eliminated. But there was one exception to this intra-group transaction, that one transaction will not be eliminated. This transaction was if there was any transaction and related to that transaction, we have claimed the losses, these reduce our taxable profits. In after entering into the tax group, the reversal of those losses and the profit, we are again taking the benefits. That transaction will not be eliminated unless and until all the previous losses has been reversed. This we have discussed in a previous lecture. Now the question is basically, as I discussed, the all intra-group transaction will be eliminated. Once this all intra-group transaction will be eliminated, in the same way, if there is any intra-group transaction for the transfer of assets or for the transfer of liabilities between the members of the tax group, this transaction will be eliminated as well. But we discussed that if any asset is being transferred to the members of the tax group, and this asset is being further transferred by the members of the tax group to a non-member, or the transferor or the transferee is leaving the tax group within 2 years from the date of transfer, then clawback clause will be applicable. Means transferor will be liable to calculate the gain on the transfer. It will be assumed like a normal transaction. Transfer will be liable to pay tax on the transfer, and if the transferor doesn't exist, group is being seized. If there are only two parties, group PSC, one party is leaving the tax group, then the group will be liable to submit the final return, again will be subject to tax. In this we have discussed in our previous lecture as well. This is the same thing. The requirement to eliminate transaction also applies to transfer assets and liabilities, but if this is being transferred within 2 years from the date of transfer, then clawback clause will be applicable unless this gain is exempt, subject to any other condition of the law. This example we have discussed in detail as well. There were one company A, company B, A and B transfer that we've already discussed. Now our focus is basically corporate tax is applicable on the tax group on its entirety, not partially. So basically, tax group is a one single taxable person, and tax group on this tax group, corporate tax will be applicable on its entirety. So let's start it from this that if we know this, if this is the one single taxable person, the taxable income up to 375,000 is 0%. Any income beyond 375,000, it will be subject to tax at 9%. Now, in case of tax group, this 375,000 exemption of taxable income or taxable profit, it will be applicable to the group level, not to the individual entities level. And they have given this thing is basically in 8.3.1, these 375,000 exemption will be applicable to the group level. But there's some sort of nominal loss to the group members, because if there are one company A, company B, company will be claiming certain exemption up to 370,000. A will be claiming, B will be claiming up to 375,000. But it means here they will be saving around up to 370 some amount. Here will be saving some amount. Once this will be consolidating, basically this exemption will be applicable one time only. So this will be some sort of nominal loss to entering into the group. But the 375,000 exemption will be applicable to the group level. Second thing, this is a small business relief. We know this, that if the taxable person having a taxable income during the tax period up to 3 million in the current tax period and in any subsequent tax period, then they can apply for small business relief, and this relief is applicable by the end of 2026. The condition is the taxable income is the income is up to 3 million. Second thing, the taxable person is not members of any multinational group. If these two conditions are being satisfied, then they can opt for the small business relief. Now, this small business relief will be applicable to the group level. It will not be applicable to the individual entity level. If you go into the discussion here, 4.6.3, you can find here the resident person up to 3 million in relevant tax period can apply. Tax group will be treated as a single taxable person. Small business relief applies to the tax group rather than the individual members of the tax group. This means revenue threshold will be considered consolidated revenue of the tax group, not to the individual entity. The juridical person eligible for small business leave revenue tax period joins the tax period no longer be eligible for small business leave. This is the same thing. If individual member is joining a tax group, the individual member will not be liable to ascertain the total revenue of the individual member. We need to ascertain the total revenue of the group. There are two conditions as I mentioned earlier as well. The tax group has a revenue up to 3 million. Second thing, there is none of the members of the tax group, important, this is very important. None of the members of the tax group is a member of multinational enterprise. None of the member. If any one single member is also part of the multinational enterprise group, the group will not be able to enjoy the small business relief. They have given one example here. I think we have already discussed this. The revenue is company A 1 million, company B 2 million, company C 3.7 million. Small business relief is not available to the group since the total revenue is more than 3 million. This example we have already discussed. So going back to the today's lecture, so small business relief will be available to the tax group instead of the individual entity level, and we need to consider the total revenue of the group. We should not be considering the total revenue of the individual entity. Then the application of ownership interest at the tax group. We know the participation exemption. Participation exemption, when is this participation exemption? We saw when the taxable person has investment in the juridical person, this investment is a minimum 5% of the share capital or in absolute value a minimum 4 million. The rest of the conditions are being fulfilled, like minimum 5% or 4 million investment for uninterrupted period of 12 months. First condition. Second is the company in which we have the investment, this company is subject to tax at least 9%. Third, the taxable person has 5% interest in the profits, a 5% share in the profit, 5% share in the net assets. And fourth condition, the company in which this investment has been made, that company is not making any further investment more than 50% in any company. If all these conditions are being satisfied, then if we are getting any dividend, any forex gain or loss, any impairment gain, or any sort of capital gain, that will be exempt from the UAE corporate tax law. But this exemption, if we are getting any dividend from the resident juridical person, it will be straightforward exempt. So this is the condition. Now the question is this 5%, whatever we are discussing here, this 5% and this 4 million. This 4 million investment and this 5% investment, this 5% investment minimum and this 4 million absolute values, this is very important. This will be the consolidated share of the parent company, of the group members. Third very important thing, any other external party of which the group member is a part of the qualifying group. Basically, this is the one tax group. All the tax group revenue will be considered. Sorry, all the tax group share will be considered. If there's any external party, qualifying group, any member of this group is a member of the qualifying group, then this share will be considered as well. Three party: parent company, members of the qualifying group, sorry, members of the tax group, and members of the qualifying group of which the tax group is a member. So these three parties total share will be considered to assess this 5% condition has been met or 4 million condition has been met. So you can read it for the participation exemption, 5% ownership interest as well as the ownership interest held by external other entities that are not part of the tax group but belong to the same qualifying group or with the member of the tax group. Basically, tax group is a member of the part of the qualifying group. That share will be considered as well. The same thing is applicable for this 4 million absolute value. Important thing, for the ownership interest for the qualifying group relief and transfer of tax losses, external parties share will not be considered. Only parent company and the related subsidiaries share will be considered. We know this, the qualifying group relief. Qualifying group relief is basically as per the law. If there is a resident juridical person or PE of the non-resident person, common ownership 75%, A to B or any other party, A owns B or C, common ownership, same accounting period, same tax period, none of them a qualifying free zone person and none of them is an exempt person. If all these conditions are being satisfied, then they can opt for qualifying group relief. Once they're opting, then the group transaction will not be subject to corporate tax. So for this ownership condition, 75% ownership is required minimum. This for the minimum 75% ownership, the share of will be considered of only group entities, parent and each subsidiary. In the same way, transfer of tax losses, if there is a common ownership of up to 75% between the resident juridical person. Here, PE of the non-resident person cannot become a part of the transfer of losses tax group. But PE of the non-resident person can become a part of the qualifying group relief, but this PE of the non-resident person cannot become a part of the group where the transfer of tax losses. The rest of the conditions are same. 75% common ownership, same tax period, same accounting standards. None of them is a qualifying free zone person. None of them is an exempt person. If all these conditions are being satisfied, then one person can transfer its tax losses to another person and maximum up to 75% of the taxable income of the recipient. So if A is transferring, all these conditions are being satisfied here. If A is transferring the losses to B, B can accept maximum 75% of its own taxable income of their losses. So, but all these conditions needs to be satisfied, whatever we have discussed. The important thing is this 75% condition, this 75% common ownership condition will be considered the common ownership by the parent company and each subsidiary. Any external party share will not be included. Like we have discussed, it has been included in our previous case where there is a basically participation exemption 4 million or 5%. Hopefully it will be clear to everyone. Application as a qualifying group relief, this is just what we have discussed basically, qualifying group relief. Now the important thing is, if the tax group makes an election for the qualifying group relief, if the tax group makes an election for the qualifying group relief, this will be applicable to every member of the tax group. Once it will be applicable to the every members of the tax group, even the group ceases tomorrow, even the members leave the group, then still this qualifying group relief benefits will be available to the group as well as to the member. In the same way, if one member is leaving the tax group and this member is joining any other tax group where none of them they have already opted for the qualifying group leave, once this member is joining this group, then this group will be the whole members of the tax group here. The qualifying group will be able to enjoy the qualifying group leave. They are mentioned here basically. This is, you can go through the tax member makes an election for the qualifying group, which will apply to all members of a tax group. Election would continue to apply to the member even after such member leave the tax group or after the tax group ceases to exist. Now, the tax group that doesn't have any election for qualifying group is treated as making election if form a tax group or join the tax group that includes one or more member, as I mentioned. If leaving tax group, joining any other group, or ceasing exist. So wherever even a single member is there who has already opted for the qualifying group leave, it will be applicable to the all members of the respective group. Now, where they have opted for the qualifying group leave, asset has been transferred in between the qualifying group. No gain or loss will be back. Asset will be transferred at the book value. Then the condition is again, This asset should not be further transferred within 2 years from the date of transfer. And moreover, none of the members is leaving the qualifying group. So if this condition is being satisfied till 2 years, then everything is fine. But if this condition is not being satisfied, means any member of the qualifying group is leaving the tax group, or transferee is leaving, or they are further transferring the asset out of the qualifying group, then the clawback clause will be applicable. Transferor or the transferee, whatever is the case, they will be liable to calculate the respective gain. They will be liable to pay the tax on it as well. They have mentioned in this paragraph. You can go through this. Application of limitation of tax losses. The important thing in this was basically, what I was trying to say, qualifying group relief applicable on its entirety as well. Application of a limitation of tax losses carry forward. Applications of limited of tax losses carry forward. We know this, that the tax losses can be carried forward. The conditions are, what are the conditions for carry forward or tax losses? All these conditions given in the law, you can go through this. Maximum 75% of the taxable income, they can carry forward the tax loss for unlimited period of time. What to carry forward the tax losses, the important conditions are that there is a continuity of business or continuity of ownership. The first condition is continuity of ownership. Second condition is continuity of business. What is continuity of ownership? Continuity of ownership law says the date these losses incurred and the date when these losses were settled. In between these two dates, there should not be any change in the ownership of the business more than 50%. This is continuity of ownership. Basically, same person is continuing the business. Maximum change of ownership can be 50%, not more than 50%. So if this is the continuity of ownership, the date losses have incurred, the date losses were settled, first condition. Second, or there should be a continuity of business, means they are operating the same business activity. There should not be any major changes. If these two conditions are being satisfied, then they can carry forward the losses for unlimited period of time maximum, and each year they will be adjusting maximum 75% of their taxable income. Now this basically condition important. This ownership condition law says basically given in the guide wealth only the interest up to the parent company. Because there will be one parent company, under the parent company there will be different subsidiaries, and each subsidiary ownership is more than 95%. That's why they are part of the tax group. Here part of a tax group 95%. So this 50% change of ownership is applicable to the parent company, because here if there will be change in ownership, they will go out of the group. This 50% change should be applicable at the parent company. It has been given here. You can go through this. Now this is change of, first is change of ownership. Second is change of continuity of business. This continuity of business, this is applicable on entirety basis, not to the individual members of the tax group or not to the parent company. It will be applicable on its entirety on overall basis. So go to go. So only the ownership interest in the parent company tax group is relevant. Here you can go through that. For the business activity, it will be applicable on the overall group level. The law this you can are determined by reference to the business activity to the tax group as a whole. You can go through this. The objective is basically for the continuity of business, continuity of ownership. Ownership we need to look at it at the parent company level. Continuity of business we need to look into this at the overall group level. Application for election of realization basis. We know this that taxable person can follow cash basis of accounting. Taxable person can follow accrual basis of accounting. If your revenue is up to 3 million, you can follow cash basis of accounting. If the revenue is more than 3 million, you cannot follow cash basis of accounting unless and until there are exceptional circumstances and you have taken approval from the FTA. Otherwise, if your revenue is more than 3 million, you cannot follow cash basis of accounting. Less than up to 3 million cash basis, more than 3 million accrual basis. Now, whenever you are following accrual basis more than 3 million, while following the accrual basis from 3 million to 50 million, you can apply IFRS for SMEs. More than 50 million, you can apply full-fledged IFRS. So option is there, cash basis, IFRS for SMEs, and third grade is full-fledged IFRS. Now, if the taxable person revenue is more than 3 million and they are following accrual basis of accounting, they have an option as per the law. They have option that they can opt their taxable gain or taxable loss. It should be taxed or allowed on realization basis. Accrual basis, basically accrual basis and cash basis. Accrual basis means whenever the gain or loss is accrued, we are booking. And cash basis, whenever gain and loss, whenever the asset is being sold, then we are booking. So this is accrual basis and cash basis. So if the taxable person is preparing the financial statements on accrual basis, they can opt that the gain and loss on the assets to be taxed on realization basis. So we know the financial statements have been prepared on accrual basis. For tax purposes, we are asking gain and loss needs to be taxed on cash basis, means it will be required some adjustment. So means if there is suppose if the one asset, the value has gone up on accrual basis, we have booked the gain, but still we have not sold the asset. So when we are opting for realization basis, we will be able to book the gain when we're selling the asset, we are realizing the gain. So for the financial statement for accounting purposes, we are following accrual basis. And for the tax purposes, we have opted to be taxed on realization basis, means it will be required some adjustment. So the group needs to decide, are we following the accrual basis or are we following the gain and loss to be taxed on cash basis, realization basis. So this will be decided by the group. The group will need to determine whether the prepared consolidates on cash basis. This decision will be taken by the group as well. The group can make an election during its first tax period to take into gain and loss on realization basis. As I mentioned, individual entity cannot take it. The group will decide the need to tax the gain or losses on the related assets on accrual basis or on cash basis. If the group has decided make an election for a realization basis, it would be the specific adjustment. Okay, if the group has decided that they need to follow the realization basis, financial statement has been prepared on accrual basis, then the loss is basically this group needs to make adjustment in the respective individual entities of the group, but the decision will be taken at the group level. If any entity is leaving the tax group, then they need to follow the same basis on which basis group decision has basically, if the group has taken a realization basis, if any member of the group is leaving the group, then they will be following the realization basis as well. So this has been mentioned in this paragraph. You can go through this. Now they're asking if a subsidiary joins a different approach. Now there is a possibility the group is following the realization basis. A subsidiary is joining, first tax period has gone. In that first tax period, the subsidiary has opted on accrual basis. Now this subsidiary wanted to join the group which has already opted for the cash basis, the realization basis. The group has opted for the realization basis. This subsidiary this subsidiary has already opted for the accrual basis, accrual basis. The group had opted for the realization basis. Now this is the exceptional case. For this exceptional case, then once this subsidiary is joining the group has already followed the realization basis. So they need to take approval, whatever they want approach they wanted to opt. This special approval will be required. Either here period will be changed, either here basically here basis will be changed, either here basis will be changed. FTA approval will be required. So basically, there is a possibility if you make election, you can go to exception circumstance only after a change in direction as subsidy join the tax group who was not elected realization. But the same thing you can go through this. Important banks and insurance. Now we know there are three different categories: accrual basis, realization basis. While opting, we need to pay tax on the gains and loss on accrual basis or on realization basis. There are three different clauses. One is basically assets held in the capital account. Second class is assets that are subject to fair value or impairment testing. And third category is assets which are revenue nature. So law says for the revenue nature items, the business cannot opt that they need to tax on realization basis. Revenue type items, they will be subject to tax on accrual basis. There is no other option. For the revenue, like stock, if you have a stock, the value of the stock is going up and down, this is a revenue type item. For the revenue type of thing, you don't have any option to be taxed on realization basis. So this has gone. Remaining two clauses are there. Two clauses is assets or liabilities held in the capital account. Second, assets and liabilities that are subject to fair value and impairment testing. All assets and liability which are as per the IAS 36, the impairment testing, you can do a lot of other asset impairment. This is basically on fair value. So two classes are there. Asset and liability on the capital account. Assets are liabilities, which is the fair value or impairment testing. These two categories. For these two categories, law says banks and insurance companies, they can opt for the realization basis only for the assets and liabilities which are held on the capital account. They cannot opt for the assets and liability which are subject to fair value and impairment testing. Now there is a possibility. Now the banks or insurance company, they wanted to join any group that has already applied for availed for the realization basket, but this includes the assets which are subject to fair value and impairment testing. But the bank and insurance company, they cannot apply the realization basis for the assets which are subject to fair value and impairment testing. The group has already applied. Again, there is a conflict. Different basis. I will not say conflict, this is a different basis. Here the bases are different, here the bases are different. Again, for this basis, special approval is required from the FTA, because if you are going through the realization basis on realization basis, they said once you have opted, it cannot be revoked unless there is exceptional circumstances. Here, this is exceptional circumstances as well. You need to take an approval from the FTA for this. Deduction of expenditures is overall decided on overall group level. Which expenditures are allowed, which are not allowed. The group will decide in overall group level, it will be decided how many expenditure. 50% of entertainment expenditure we cannot claim, remaining we can claim. The basic condition, all expenses related to the business. If all expenses related to the business, we can claim, otherwise we cannot claim. This decision will be taken on overall group level. Application of the transitional rule. This transitional rule, again, transitional rule, we know this. Last is basically latest financial statement prepared on IFRS basis. The closing balance of the latest financial statement will become the opening balance for the tax period. So, and this closing balance needs to be prepared and brought forward based upon the arm's length principle. Now, whenever you are bringing any asset from the previous period to the new period, the previous era was not subject to tax, the new era is subject to tax. The era that was not subject to tax, if you're holding that asset for the last 5 years, might be the value of the asset has gone up. You would bought an asset of 1 million, now it has become 4 million. Now this 4 million, 1 million to 4 million, this gain is not subject to tax because tax was not applicable during that time. Now if it's 4 million, which is the market value of the assets onward, the asset may be subject to tax, maybe it's not subject to tax. The important thing is we need to bring the asset at the market value from the previous period to the new period, from the non-tax era to the tax era. We need to bring the assets at the market value at the fair value. So whatever the approach they are adopting, the opening balance, basically election in the transition needs to be taken at the group level on its entirety at the group level. The opening balance of the tax group is the consolidated balance sheet of each member of the tax group on the last day of the financial year immediately preceding the, okay, we have already discussed. Election in respect of transitional rules needs to be made by the tax group and will continue to apply to the members of tax group even after they leave the tax group or tax group ceases to exist. We need to opt for the adjustment. The period that the person were holding, it will be considered an overall level. If member A was there, B was there, C was there. Overall, it will be considered if these all members of the tax group right now will see how much time A was holding, how much time B was holding, how much time C was holding. The ownership of the period determined combining the overall period held by the members of the tax group. You can go through this example basically. Company A was formed, then B was formed. B was the basically 100% subsidiary of A. Then they were decided to make a tax group on 1st Jan 2022. They transferred the asset to A to B 12 million. Then they made a tax group here. Once the tax group was made, then tax started. Tax was started on 1st of Jan 2024. On 1st of Jan 2024, the book value of the asset was 12 million. Cost was 10 million. Book value was 12 million. Market value is 19 million. Now on 9th June, the company B sells the immovable property 20 million. As a result, company B provides the gain of 8 million in its financial statement. Now they are asking basically what are the, as a result, the group will gain. What is the gain? Pre-tax era gain, post-tax era gain. So what was the fair value of the asset? 19 million. This was the fair value of the assets on 1st of Jan 2024 when tax was started. This is the fair value of the asset. In this fair value, how much is the gain that pertain to the non-tax era, previous period, where the book value was 12 million, market value was 19 million, difference is 7 million. 7 million that will they need to exclude because this gain is not subject to tax. It needs to be eliminated, it needs to be removed. And this decision will be taken, as I mentioned earlier, will be taken at the overall group level. Treatment of subsidiary is basically this is last thing. Last thing is basically what are the treatment. Now this is a company A. Company B, company A is holding 95% share in B. So when for tax purposes, company A and B will be required to prepare the consolidated financial statement. Law says this parent company will consider 100% of the assets and liabilities of B in its books. And this is, and the remaining will be considered as a part of the 5% as a part of the capital. Might be they will be required to consider a minority interest 5%, but on overall basis they said 100%. That means that any income realized by the subsidiary should be included in full in the taxable income of tax groups. Unless eliminated through intercompany transaction, even the parent company doesn't wholly own the subsidiary. Parent company, even the parent company is holding 95% share of the subsidiary. Still, this parent company needs to consider 100% taxable income of the subsidiary. At the level of group, the ownership in subsidiary is held by the parent company who are not member of tax group is recorded as a part of the tax group capital. If they are selling it, basically profit distribution within the tax group, it will not eliminate it, it will not be subject to tax. If the parent company is selling shares in subsidiary to a third party while continue to meet the condition of tax, any capital gain, it will be based upon the participation exemption. If the parent company is selling and all those conditions are being satisfied at a participation exemption, then it will be exempt from the corporate tax, otherwise it will be subject to tax as well. So thank you very much from my side. Really appreciate your support. We have discussed taxable, how to calculate the taxable income of the tax group. So next attribution of taxable, I don't know how much time, further time it will take. We need to wind it up as soon as possible. We have so many other important areas to discuss. So we have concluded taxable income of the tax group, attribution, tax losses, interest deduction rules. Well, I think might be it will take 2 further lectures. Thank you very much. If you have any question, you are most welcome. Yes, please. Dipesh. Yes, Dipesh. Do you have any question? Can you please share the short summary of today's lecture? The short summary, you can you can go through my latest article that was published in the Khaleej Times. I think it was published yesterday.
Yes, and Dipesh, I will be recapping this lecture in our next webinar, so you can wait for that as well. So you will get a short summary.
Agreed. So Ms. Faiza, she will be recapping it. You can go through that. You are asking from where I can get the link. You can basically you can Google application of corporate tax on its entirety. Khaleej Times, you will find this article. So any other question? If you are not finding, you can drop me an email. I will share the link. Okay, guys, take care. Thank you very much. Ms. Faiza, thank you very much. Have a lovely
Thank you,
evening.
everyone.
Thank you. Bye-bye.
Bye-bye.
Thank you. Bye-bye.